Imagine it's 1955. You've worked hard. You've saved a little money. And now you want that money to grow. So, what do? There's no investing app, no online broker, no buy button. You can't drop 20 bucks into an S&P 500 fund while waiting for your coffee. In fact, the low-cost index fund, the investment millions of Americans now use without thinking twice, doesn't even exist yet. Your choices are limited. You can leave your money in the bank, buy a house, trust your employer's pension, purchase government bonds, or walk into a brokerage office and hope the person sitting across from you gives honest advice. And that last option? It could get expensive, fast. So how did ordinary Americans build wealth before index funds? The answer isn't one single investment. It's a story of land, war bonds, pensions, expensive salesmen, market crashes, and one supposedly ridiculous idea that Wall Street wanted nobody to take seriously. But before we reach that idea, we need to understand something important. For most of American history, investing wasn't designed for regular people. Go back to the early 1800s. For the average American, wealth didn't mean owning shares in hundreds of companies. Wealth was physical. It was farmland, a house, livestock, tools, a family business, maybe some gold or cash hidden somewhere safe. Yes, stocks existed, but buying them wasn't simple. You needed access to a broker. You needed information. You needed enough money to make the transaction worthwhile. And even then, you were entering a market with weak protections, limited transparency, and plenty of manipulation. There was no federal deposit insurance either. If your bank failed, your savings could disappear with it. That happened more often than most people today realize. So ordinary families didn't build retirement portfolios. Many didn't even have a clear concept of retirement. You worked until you couldn't. Then your family helped support you. It was simple, but incredibly fragile. One illness, one failed harvest, or one dishonest bank could wipe out years of progress. Then, something happened that pulled millions of Americans into the financial system for the first time: a war. When the United States entered World War I, the government needed a huge amount of money. Its solution was brilliant. Don't borrow only from giant banks and wealthy financiers, borrow from the public. The government began selling Liberty bonds to ordinary Americans. Posters appeared across the country. Celebrities promoted them. Public rallies turned buying bonds into an act of patriotism. The message was powerful. If you couldn't fight in the war, your money could. For many families, this was their first real investment. They gave money to the government and expected to receive interest in return. Suddenly, investing didn't feel like a private club for wealthy Wall Street insiders. It felt American. But there was a problem. Liberty bonds could be traded, which meant their prices could fall. Some working families needed their money before the bonds matured. When they sold early, they sometimes got back less than they had paid. Think about that. Millions of people had finally been convinced to invest, and some were immediately punished for needing their own money. Still, the door had opened. Americans now understood that money didn't have to sit inside a jar or underneath a mattress. It could be put to work. And during the 1920s, that idea became dangerous. The 1920s felt like the future had arrived all at once. Cars were everywhere. Radios entered American homes. Factories expanded. New companies grew rapidly. And stock prices kept climbing. People who had never considered buying shares suddenly wanted in. Brokerage firms made it easier. Newspapers celebrated market success stories. Investment companies promised professional management. Best of all, or worst of all, you didn't need the full amount to buy stocks. You could borrow most of it. That's called buying on margin. You might put down $10 and control $100 worth of stock. If the price rose, your profits could be huge. Sounds amazing, right? Here's the catch. Losses were magnified too. But during a boom, nobody wants to hear about the catch. People saw friends, co-workers, and neighbors making money. The market began to feel like an elevator that only traveled upward. Then, the cable snapped. In 1929, stock prices collapsed. Investors who had borrowed money were crushed. Banks failed. Businesses closed. Millions of jobs disappeared. Even people who had never purchased a single stock suffered. That crash created a fear that lasted for decades. To many Americans, Wall Street wasn't a place where wealth was built. It was where wealth vanished. After the Great Depression, the government introduced stronger financial rules and protections. Bank deposits became safer. Securities markets faced greater oversight. Savings bonds were designed to be friendlier to small investors. Then, World War II brought another enormous bond campaign. Once again, regular Americans bought government debt. But after the war, the typical family didn't suddenly become a family of stock pickers. Instead, middle-class wealth was usually built through three things: a home, a pension, and steady saving. A house became the largest asset many families owned. Every mortgage payment helped build equity. Meanwhile, workers at large companies were often covered by traditional pensions. The employee didn't choose stocks or monitor the market. The employer managed the pension fund and promised the worker a monthly payment after retirement. For the employee, it felt automatic. Work for the company, stay there for years, retire with a check. Life insurance was another common tool. Some policies built cash value over time, giving families both protection and a form of forced saving. None of this required an investing app. But there was a serious weakness. Your financial future often depended on your employer staying strong, your home retaining its value, and your insurance or pension provider honoring its promises. And if you wanted to invest directly, Wall Street was ready to help, for a price. Imagine investing $100 and immediately losing several dollars to commissions. Your stock hasn't fallen, the company hasn't failed, the market hasn't even moved. You're already behind because entering the game costs money. That was normal. Stockbrokers charged commissions, and small investors were often hit especially hard because fees consumed a bigger portion of smaller transactions. Mutual funds appeared to solve the problem. Instead of choosing one company, you could purchase a professionally managed collection of investments. Great idea, but many funds came with large sales charges. You could hand over $1,000 and a significant chunk might go toward paying the salesperson before your money was ever invested. And the person recommending the fund might earn more for selling one product than another. Was it the best fund for you, or the best commission for them? Most customers had no easy way to know. Wall Street's message was clear. Successful investing required expertise, and expertise was expensive. Then, a group of researchers asked an extremely uncomfortable question. Was it actually working? Researchers began comparing professional fund managers with broad market averages. Some managers performed brilliantly, but many didn't. And after subtracting management fees, trading expenses, and sales charges, beating the market consistently became even harder. That led to a strange idea. What if you stopped searching for the winning stock? What if you stopped searching for the genius manager too? What if you simply bought a tiny piece of the entire market and kept your costs low? It sounded lazy, almost foolish. Wall Street was built around action, researching, predicting, buying, selling, and finding hidden opportunities. This new strategy was built around doing less. The earliest index portfolios were created for large institutions, not ordinary households. Regular people were still locked out. Then, in the mid-1970s, two major changes arrived. First, fixed brokerage commissions ended, opening the door to greater price competition. And then, in 1976, John Bogle launched a public fund designed to follow the S&P 500. He wasn't promising to beat the market. He was promising to capture its performance at a low cost. Investors were not impressed. The fund raised only a small fraction of its original goal. People inside the financial industry mocked it. Some called index investing un-American because it made no attempt to select the best companies. But that failure contained a revolutionary idea. The index fund didn't give ordinary investors a magical advantage. It gave them something more useful. It reduced their disadvantages. One purchase could provide exposure to hundreds of businesses. One failing company didn't have to destroy the entire portfolio. There was no need to predict which stock would become the next superstar. And lower costs meant more of the return could remain with the investor. But the biggest change wasn't mathematical. It was emotional. Index investing told ordinary people, you don't need to be a genius. You don't need a hot tip. You don't need to check prices every hour. And you don't need to pay someone a fortune to make investing look complicated. You can own the market, remain patient, and let time do much of the work. Today, investing is easier than at any earlier point in American history. But easier doesn't always mean safer. The same phone that lets you buy a diversified index fund also lets you gamble on options, chase viral stocks, use leverage, and panic sell during a bad afternoon. The old barriers were paperwork, high commissions, and limited access. The new barrier is noise, constant alerts, endless predictions, fear when prices fall, FOMO when prices rise. Technology changed the tools. It didn't change human nature, and maybe that's the most important lesson in this entire story. Before index funds, ordinary Americans built wealth through land, homes, bonds, pensions, insurance, and personal businesses. Some succeeded, some lost everything. But they were often forced to depend on institutions and experts they couldn't fully evaluate. The index fund didn't eliminate risk, it didn't guarantee wealth, and it didn't make patience easy. What it did was quietly shift power. It allowed a school teacher, factory worker, nurse, or young couple to own pieces of the same major companies held by giant financial institutions. No secret connection required, no massive fortune needed, no prediction about tomorrow's winning stock. Wall Street spent generations selling the idea that wealth required complexity. Then, one boring little fund revealed something far more powerful. Sometimes, the smartest financial move isn't finding a way to beat everyone else. It's staying in the game, keeping more of your own money, and giving it enough time to grow.